to those who I haven't spoken to already in 2025. So, this week is called A New Start, as we do the first supplement of 2025. And as you'll know, if you've listened before, I like to start with a quote. And this week's quote is, although no one can go back and make a brand new start, anyone can start from now and make a brand new ending. And that's from Carl Bard, the American author. So before I get started, I just want to know if you're someone who needs and wants to kickstart their 2025 by joining a group of property investors and developers who are committed to moving forward this year. The Boardroom Club that I've run alongside Rod Turner for over 4 years now has a couple of available spots. And if you're in property, operating at a level below you can achieve or that you want to achieve, Boardroom Club may well be the thing that gets you to level up. We meet monthly on the second Wednesday of the month, 9 times a year via Zoom, 3 times a year face-to-face. We also have one-to-one calls once a month and WhatsApp support whenever it's needed. We've welcomed investors, developers, traders, brokers, people with property businesses, people with non-property businesses, and we continue to do so. If you'd like a no-obligation chat about Boardroom Club, drop me or Rod a message on LinkedIn. And you can find me on LinkedIn under linkedin.com/in/Adam G. Lawrence. And if you're not interested in Boardroom Club, make sure you connect with me on LinkedIn anyway. So welcome to the supplement, hitting the ground running in 2025. No real-time market update again this week as the industry takes that 2-week time out over Christmas. We will have the final 2024 numbers in due course when Chris Watkin is back doing the updates next week. The deep dive this week goes into the Resolution Foundation report that was released just before Christmas that's called Housing Hurdles, that I've wanted to get my teeth into ever since it came out, but I couldn't find the time. So in the real-time slot, Chris himself sent me over some figures of interest that I wanted to share this week. I think they might be helpful to everyone whenever choosing an agent to sell an asset. The next part is my edited version of Chris's text on the matter, because he's coming at it from the angle of advising estate agents, of course, and talking to the industry, whereas I want to inform investors. So, Chris called this the surprising factor that could boost a property's chances of selling. Over the last 2 years, 3,052,987 homes have left estate agents' books across the UK. Bear in mind that doesn't mean they were sold, because of those 3+ million, only 54.51% went on to exchange and complete. That's a seriously sobering statistic for homeowners who entrust estate agents to see their property through to the finish line. The remaining homes were withdrawn off the market unsold. But what if he told you there's a model of estate agency that seems to outperform this national average? So, Chris is good at taking a closer look at the numbers, and he focused on the estate agency's brands in the top 50, that's just by size of transaction, number of transactions, to 52.7. Nothing particularly groundbreaking there. The bigger they are, the less they look after you, as it turns out. But the devil's in the detail, and in that top 50, there are some self-employed models and franchise models where the same individual handles the valuation, the vendor management, and the offer negotiation. That's 100% of the time in the self-employed model, and it's a very, very common practice in franchise-led, owner-operated estate agency models. So with those firms, the exchange success rate jumps to 59.49%. So the top 50 exchange at 52.7, and self-employed and franchises at 59.49. Might not sound like a lot of difference, but it's 12.88% more exchanges. It's definitely statistically significant. So not only that, but a lot of money also saved for vendors ultimately, because holding on to empty properties costs money. Trying to sell one and having to abort the sale costs money, serious money these days, in days of double council tax, apart from outstanding finance, apart from everything else you have to consider when you're selling a property and you're selling with vacant possession. In many traditional estate agencies, the valuer who wins your instruction hands off the property to a negotiator to vendor manage and negotiate, creating a potential disconnect in accountability and client relationship, is how Chris sees it. Whereas in contrast, the self-employed agent and most franchise operators handles everything from valuation to listing to vendor management to offer negotiation. And that continuity means stronger relationships, one person deeply invested in the sale, accountability, no passing of the buck, And expertise at every stage. The same professional who knows the market inside out is with you all the way. So are listers less likely to overvalue if they're responsible for the vendor management, Chris asks. Now that's something that every savvy asset owner needs to look out for if you're selling a property. Do the agent just tell you what you want to hear? Or could there be another factor I'm missing, Chris asks himself, like these estate agents mentioned, self-employed and franchise, owner-led, so they've got skin in the game. I'd suggest maybe they're just better or more highly skilled. That's very possible indeed. Or is it something else altogether? I'd also be interested in any other thoughts on this issue, and I'm sure Chris would too, and I'll pass them over to him if anybody wants to be in contact with any. So that was even more fun than the normal real-time market stats, but we'll be back to those business as usual next week. Macro remains fairly tricky at this time of year. We had enough to go on though, because we have the nationwide house price index, the final manufacturing PMI for December, and also the Bank of England money and credit report. Now that's always a few days late at this time of year. This is November's report that would normally come out late December, but actually is usually delivered in the first week of January. And you know we have to end contractually with the gilts and swaps, not a habit we'll be breaking throughout 2025, I'd imagine. So without delay, Nationwide printing 4.7 for 2024, against their conveniently forgotten, of course, by them, but not by me, prediction from 12 months ago, which was verbatim, house prices are likely to record another small decline or remain broadly flat, perhaps 0 to minus 2% over the course of 2024. Not very committal really, but 5 to 7% out on their own numbers depending on how you manage it, which in the forecasting world, in an asset class that doesn't really move a huge amount in a year, is very weak indeed. And yep, I said they'd go up 5%, so I love a good pat on the back as well. Of course I do. Thank you. Anyway, into Nationwide's details. Northern Ireland won once again, like they did in 2023, 7.1% up in 2024, according to Nationwide. There's been many a year of not a lot of growth in rents or capital values in Northern Ireland, so this hasn't broken anything just yet or created some kind of unsustainable bubble in Northern Ireland. And as I've said many times before, and I'm surprised we don't see this case being put forward more in the media, and perhaps it's just the disconnect between the mainland and Northern Ireland, but they do appear to be the actual beneficiaries of Brexit, the way things are going at the moment. There was a monthly house price increase of 0.7, which was perhaps a little too healthy month on month, but from Nationwide's perspective, we're not yet pressing all-time highs. Their chief economist Robert Gardner commented that activity and prices were surprisingly resilient to him. However, they share a number of graphs each quarter, and the pick of them this time for me is the HPER, house price to earnings ratio. You can see where it sits compared to the last time we had a stable market, which was generally the 2010s. And one of the things that runs across a lot of Nationwide's graphs, unfortunately, is they don't really explain well enough why they're using the trend lines that they're using, or the averages that they're using, or the averages they're using aren't that meaningful for a number of reasons. So here's an argument I'd make here. If we go back 35, 40 years, or 30 years even, there's not the same culture that there is these days in terms of two earners being in a household. So you are in between. If you go back 40 years, let's say we're going back to 1985, you're at the start of the point, or relatively near the start of the point, where you started to get more towards a two-income household, and therefore it changed the scope of everything. You didn't have the one-income nuclear family so much anymore. You did in the more mature households, but you didn't in the households that were breaking through at the time. Now those households have very much broken through. The expectation is that both people will work realistically, and there'll be some kind of break, flexibility, and all the rest of it around the time of having children, if that's a route the household goes down, which more households these days don't go down that route. So therefore, trying to compare those two things over a 30, 35, 40 year time frame is fairly pointless. But my point around sharing the HPER graph is that price versus earnings, we're back to where we were roughly in the sort of 2010s, which was a pretty steady and stable market for most of it, not for all of it, of course. But that's not really what the media would have you believe, unfortunately. We also, I remind you, have the following wind that wages are still up 5.2% on last year's figures, and we've got 6.7 baked into minimum wage, regardless of the difficulty for some businesses and sectors in affording these wage rises. So Gardner points to the fact that record rental growth is making it even harder to save deposits. I don't know on reflection I've ever seen any figures of what percentage of first-time buyers move from a rental rather than moving straight from mum and dad's. or from a single let to a first-time house versus from an HMO to a first-time house, for example. If anybody's got any access to this sort of data or has ever seen any, I'd love to hear about it, and I'd love to analyse it as well. He also points to increasing mortgage approvals month on month, which was a little bit silly because we know what happens to rates in November after the budget. More on that when we get to the Bank of England report, though. He talks about stamp duty volatility, which I'm sure is bound to be correct, but this is a smaller bump than previous bumps in the road, and it's not a linear relationship. I think it's probably more headaches for the conveyancers than anyone else, rather than causing sort of huge volatility. But there will be clustered fall-throughs, which is one of the things that I will be looking for at the turn of March, April this year, and in the weeks surrounding that point in the calendar. The prediction of concentrated transactions in early 2025 and then a commensurate lag in Q2 and Q3 is highly likely to play out, all else being equal. Their range for 2025 is 2 to 4% growth, although their logic is really unchanged from last year. The biggest worry for me, my number at the turn of the year, is 3.75% upwards for this year. So I'm right in with the pack, but that doesn't unsettle me enough to change my prediction. However, I think it's just things have calmed down a bit more and it's easier for the bigger houses to predict realistically. Or they're just seeing we're back to sort of business as usual. But apart from Northern Ireland, Scotland was up 4.4%, Wales 2.7%, and then in England, the North did the best, running through the Midlands in an orderly fashion, with London and the South East bringing up the rear, although East Anglia was the weakest, which only went forward 0.5% according to Nationwide. 3.1 was the number in England, 4.9 was the North and Midlands number. So, get your head around this, and this does make me question how good Nationwide's figures can ever be. Mathematically, the next bit is an impossibility, as I see it. I'll be very happy to be corrected, but I can't see how I can be wrong. Nationwide broke down the growth into flats, terraces, semis and detached houses. Terraces did best at 4.4 year on year. Flats did 4, semis did 3.4 and detached did 3.2. How does that happen when the overall market is up 4.7, that no single component part of the market is up even 4.7%? It's just not mathematically possible as I see it, and so I think that's quite concerning on a number of levels. But perhaps it's an anomaly of there being 1 month difference in the data. I'm not really sure. They don't really qualify these things. It's a very high level and pretty snapshot report they dish out every month. So I'm sure it's probably just a month's anomaly in the data. But it does seem a big departure for 1 month. Anyway, enough of the Nationwide and on to the manufacturing PMIs. This one hit the headlines because it underperformed even a weak outturn and printed only 47. That's an 11-month low, and the headlines from the report tell us all we need to know. UK manufacturing output, new orders and employment fell at faster rates in December. Couldn't be more miserable apart from a genuine shock or crash, although some are arguing the budget outcome is a genuine shock. Job losses as rising cost pressures drive restructuring efforts. That's the only rational way for business to respond to Rachel Reeves' efforts. Business optimism dips to a 2-year low as economic outlook weakens, and it has in a really significant way. I'd estimate that close to 1% should have been shaved off most GDP forecasts for 2025, and if it hasn't been, it will be, slowly and painfully, as we limp towards April with the private sector muttering and shaking its head. Heaping on the pain, exports also weakened in manufacturing. SMEs hit particularly hard. Tell me a situation on the downside where that isn't the case. The little guy always loses out, don't they? The smallest in every market get hit hardest by austerity, by tax rises, as a rule. Global market conditions aren't helpful, but of course we can't worry about what we can't control. Then one final knife in the guts from the report. The Bank of England is likely to remain cautious about further interest rate cuts, despite rising signs of economic difficulties. This does start to sound very close to a dictionary definition of stagflation. Manufacturing, remember, is a minority part of the economy these days, but still plenty who are listening will have tenants who are involved in the industry, and it isn't so small as to not have a major lag impact on economic growth aside from anything else. Enough anyway. I seek never to inspire misery, but to ensure we have our eyes wide open on the economic situation, which is not likely at this point to trigger a house price correction anyway, but doesn't help with overall price and rent growth, and overall growth of the economy as well. The Bank of England Money and Credit Report is certainly more important for the health of the credit markets, which are a huge driver of house price health. So, the headlines: mortgage net borrowing down, still positive, but down £1 billion to to 2.5 billion for the month in November, after a healthy October. Mortgage approvals down, but only by 2,600. Limited consequence in that move. They stayed above my rude health market indicator of 65,000, but only just, and they printed 65,700. Net consumer credit borrowing was stable, just under £1 billion on the month. The money supply contracted after a huge expansion in October, which is somewhat of a relief because that October number was anomalously large and therefore gives us no cause for concern. And November was also a net repayment month for lending to private companies and households, with net figures moving down by a couple of £1 billion. So, going down a level into the detail, in spite of lower net lending on mortgages, the rate of growth still moved year on year from 1.1 in October to 1.3 for November overall stock of mortgages. Very sustainable sort of credit rise, or under sustainable really. And the 12-month average for approvals is 60,400, and your 60k is sort of your base level for a functional market really. So 65,700 is still well ahead of the 12-month rolling average. Remortgages are similar. They hit 31,200, down 300 on October's number, but above the 12-month average of 30,000. Again, a fair historical baseline for a working market. The EIR, that's the effective interest rate, which is one of my favourite numbers, was down to 4.5% in November. So that's the average rate at which people draw down mortgages that's reported to the Bank of England by all of the big lenders all put together. So remember, these drawn mortgages were agreed several months before, when gilt yields, swap rates and all the rest of it were lower, so mortgages were cheaper. But that's down from 4.61 in October. And likewise, the outstanding stock of debt rose to 3.8% on average from 3.78. So the gap between those two numbers is continuing to narrow. And when they cross over, I think it will be fair to say the housing market has fully absorbed the normalisation of interest rates. When's that point coming? Some point over the next 12 to 18 months, probably. We'll have to see what happens to the interest rate, of course. The gap looks small, but 4.5% is still 19% higher than 3.78%. So don't underestimate the ongoing pain of that number as things continue to converge. As a comparable, instant access deposits got 2.21% on average in November. Timed deposits, so that's like fixed period, building society bank bonds if you like, got 3.8 on their outstanding stock. That's exactly the same as the outstanding stock of mortgages. But remember, there'd be income tax to consider between those two. And the new timed deposits, bonds, got 4.02. So only 0.48 lower than the average mortgage drawdown. So that margin in the middle, the difference between the 4.5 and the 4.02, really is tiny when you think about it. But it's those who don't use the time deposits and also have specialist needs, lower credit scores, are delinquent. They pay all of the profits of the banks. And by the looks of that, they pay some of the operational costs as well these days. But if you think banks are working to big margins at the moment, this proves they're just definitely not. The tax, as it has been for so often, is on not being financially sophisticated. And this really started to emerge in society in the 1980s with financial deregulation, although you could argue it's been around since the 1800s or even before that. On the same topic, SMEs paid 7.17% on average on new loans in November. Bigger companies paid 6.56%. There's the tax on not being large. So just closing the money and credit section, the money supply is still not back where it was in October 2022, thankfully, which has helped inflation a lot. It did increase by about 3.4% in 2024, which isn't far off where inflation ended up, although it's more likely to be a forward predictor of inflation than to track it in real time. So now it's that part of the macro section where I look at the 5-year gilts and swaps markets. The gilts had a very small down week on yields, with a break, of course, as trading stopped at lunchtime on New Year's Eve, as is traditional, and then had New Year's Day off, of course, moved from 4.409 at the open to 4.385 at the close. So a nothing week really, as is so often in these thin trading weeks. And 12 months ago I felt the complete opposite. 12 months ago we were at a point that was too low on the yields. Now we're pushing the ceiling, especially with the economic pressures that exist. Ultimately though, the market is a function of supply and demand. The SONIA 5-year swap closed at 4.01% yield on Thursday night. It was 3.782 1 month ago and 3.411 12 months ago. But as I say, 12 months ago, it was also at a premium to the gilt yield. It was about 10 basis points in front of the gilt yield. Now it's a discount of 37 basis points or so, which is 0.5% of difference just in margin, which is an incredible shift really in the favour of the borrowers. If the higher rates do hit mortgage borrowing further, which they likely will, but we need to let the stamp duty bump on the 1st of April play out first, that will affect the demand for the swap even more, of course, downwards. And that leaves us at my current position, which is 6% rates for no-fee limited company debt, 8.6% for workable investment property yields if you have any dreams of meaningful positive cash flow, certainly in a larger operation. So, into the deep dive. I've still got the English Housing Survey in my sights, but there's a report which generated some headlines of interest that I really wanted to get stuck into for a few weeks now, and I don't want to wait any longer. It's so rare you see the sort of headlines it generated that I just had to focus on it. The report's called Housing Hurdles and is published by the Resolution Foundation. If you're not familiar with the foundation, Wikipedia make 2 points. Firstly, it's been awarded an A rating for transparency by the Who Funds You project, and is quoted more often by political parties that are left of centre. My personal view, it's left-leaning, but it's not to the point where it makes itself inherently biased, and the output that's produced is worthwhile and reasonable content. If anything, that's proven by the headlines from this particular report, which were, home ownership is rising for young millennials, but the divide between rich and poor is widening. Now, the first part of that is a point I've been making for years with the output of the English Housing Survey and the likes, and it's completely contrary to what most of the media says all of the time. I've run a number of polls on LinkedIn around this sort of subject, and all they've really done is prove that even an engaged and intelligent audience don't have a clue what percentage of 25 to 34-year-olds, for example, own a house, and whether that situation is getting better or worse. The latter point in that headline is also one I think you'd find hard to deny. To me, it seems openly visible. Massive surges post-pandemic in temporary accommodation. Rents, now having caught up, moving past inflation and heading for income growth as well. But if you use 2021 as the benchmark rather than 2015 or 2009 or 2005 or whatever, rents are increasing much faster than incomes over the past few years. The report itself is 22 pages long, but don't panic, we're not going through the whole thing, and it was released in late December. The Resolution Foundation exists to improve the standard of living of low to middle income families. It was established in 2005, and that's their stated goal. Now, here's where they start in their own words, and of course the first bit was used as the headline for the very few organisations that did report on it. The recent uptick in home ownership rates and fall in the share of income spent on housing amongst 25 to 34-year-olds represent a remarkably positive development in the largely bleak landscape of youth home ownership. However, these developments do not capture the full picture of the housing market for young people. This note explores recent changes in young people's housing circumstances with longer-term trends. While rising home ownership rates have reduced the share of income spent on housing, ownership among 25 to 34-year-olds remains far below previous generations, and significant inequalities persist across income groups and regions. Addressing barriers to home ownership and affordability must be a priority. The government's commitment to build 1.5 million homes is a step forward, but further actions such as relinking local housing allowance to local rents could better support low-income families. So, they've given us the answer, or what they think is the answer, before we start. But let's get on with their points in the exec summary with some of my commentary. So, young people's home ownership prospects appear to be turning a corner. Younger millennials, born between 91 and 95, are now slightly more likely to be homeowners by age 25, 14%, than those born a decade earlier, 13%. What makes this difficult is we have no idea on the lag of major events. Rents at the moment are going up like a rocket, as we know, on existing tenancies. How long before this manifests in fewer 25 to 34-year-olds being able to get on the ladder? Because that's a group of the population that are heavily reliant on the private rental sector. Also, how much of the 13% was because of the financial crisis 10 years ago and not being able to get funding in 2013 to 14 or in the years approaching that? Now, by 13-14, the credit markets had been repaired. The mortgage market review had been implemented, but people and lenders still carried global financial crisis scars, I'd suggest. This trend coincides with the rise in home ownership across the 25 to 34-year-old age group, which broadly overlaps with those younger millennials today. Home ownership rates for 25 to 34-year-olds have increased by 6 percentage points since its low point in 2015-16 to reach 31% in 2022. Now, I think the size of this conclusion is understated. I don't know whether that's deliberate or not. You would only have to speculate. If you do suspect the Resolution Foundation are deliberately biased, you would accuse them of that. As I've said, I generally find them to be fair, but they are making a mistake here that many analysts do make, stopping before spelling out the whole picture. There's also a second mistake here as well, which grinds my gears more than anything. The first error is only quoting percentage points. If home ownership for that entire segment of 25 to 34s has moved from 25% to 31%, that 6 percentage point increase is actually 6 over 25, a 24% actual increase. Now that's statistically very significant. It's a massive shift, in fact, and it's a big improvement that's well worth publishing, well above the very small move in the 1991 to 1995ers. The second error is using the English Housing Survey or equivalent data from 2022 to 23. We've already had the 23 to 24 EHS. Now, the data in the 22-23 EHS ends at March 2023, has mostly been collected through 2022, in which about half of 2022 had still had very favourable mortgage rates. So it's now unnecessarily out of date. Why do this? It doesn't help anyone, and it doesn't help the cause of this research being meaningful, in my opinion. Anyway, the share of income 25 to 34-year-olds spend on housing has also fallen in recent years. The average share of income spent on housing in 22-23 was 22%, down from 27% in 15-16. And once again, you'll see exactly the same critique that I've just applied can hold again. That's an 18.5% actual reduction, going from 27 down to 22%. And you'll also realise it just goes hand in hand with my last point. All the other critiques hold as well. Anyway, despite these recent improvements, 25 to 34-year-olds today remain far less likely to own their own home compared to those in the early 1990s. So this 31% home ownership rate in that age bracket was actually 55%. That was the peak in 1990. They're far more likely to live in the private sector, private rental sector, 10% to 33% over the same period, and far more likely to live with parents, up from 16 to 22%. Now, I apologise in advance here because this analysis piece is quite long, but I need to say all these things. Firstly, when you cherry pick a peak, you're always definitionally going to be below that peak. That's obviously true by definition, right? Secondly, a massive recession was underway where a lot of damage was done in repossession and cost a generation after 1990 a lot of housing opportunities. Thirdly, let's make no bones about it, the difference between the two time periods is nonetheless extremely significant. What else has changed since 1990 for 25 to 34-year-olds, right? A 25 to 34 is just not at the same part of their life and career as they were in 1990. Let's just think about full-time education, right? 15% of them, if that, would have been to university in 1990. The participation rates were actually between 8 and 19% in the 70s and 80s, which is when they would have gone to university if they were 25 to 34 in 1990. That now compares to 50% or so. The 49% marker was first reached in 2011. That's a point that frankly is never made anywhere that I've seen, but it is a really significant one that's really going to impact things. By 25 years old in 1990, 85+% of that population would have had at least 7 years at work, and a significant percentage would have had 9 years at work. I haven't even gone into the figures of full-time education between the ages of 16 and 18 and how many people carried on for O-level, from O-level to A-level, or from GCSE to A-level as it became, right? So it's a massive point and massively statistically important. So instead of having 7 or 9 years at work, in 2022, far fewer would have had 9 years at work. Only 50% rather than 85% would have had 7 years at work, and 50% would have had 4 or fewer years at work, especially if they've done master's degrees and PhDs, and you can absolutely guarantee the participation of those degrees has also gone through the roof in that timescale. Now that's going to make less of a difference to you at 34, but it's a huge difference at 25, so it massively skews the value of this sort of temporal analysis. Then consider working age lifetimes and life expectancy. A 25 to 34 in 2022 is expected to work until at least 70, unless they've got their head in the sand. And in reality, pension and budgetary constraints mean they likely need to wait until they're maybe about 72 by the time they get there. A 25 to 34 in 1990 was expecting to retire at 65. Bad news, not that bad. A few managed it, the ones that were 34 in 1990, and the worst case is actually 67 for those who were 25 in 1990. Their life expectancy is also distinctly different. A 30-year-old in 1990 would have been expected to live to age 77. Males would have been 2.5 years under this, females would have been 2.5 years over. In 2022, this had moved to 82, and there was a bit less of a spread. Men 80.3, women 83.7. 5 whole extra years of life, 3 of which were actually being spent at university, if you follow that logic through, for lots and lots of those people. So any analysis not adjusting for this is pretty drastically flawed, especially for the 25-year-olds. This, of course, would affect deposit saving, it would affect living with parents, and of course then it affects home ownership. What would I do? Well, compare 25 to 34s of 1990 and that period to 27.5 to 36.5-year-olds of 2022. That's not exact, but given the above, you can see it makes much more logical sense than just arbitrarily sticking with the same age band. You should probably go higher than that. University has a huge double cost of not earning, apart from half part-time work that's highly unlikely to be career specific, and also costing a significant amount of money and or landing you with a huge amount of early debt to deal with in your life, or graduate tax, or however you want to look at it, that you repay at a relatively low income threshold. Ran over. So there are also stark disparities across income groups. The most recent uptick in home ownership rates for 25 to 34s has been the largest amongst middle and high income families, widening the home ownership gap between them and families on lower incomes. I'm not really sure I can add anything to something that just isn't really that surprising at all, I'm afraid. Families on lower incomes also face disproportionately high housing costs in relation to income. While fewer than 1 in 4, 24% young families, spend more than 30% of their incomes on housing costs, this proportion jumps to more than half, 53%, amongst families in the lowest income quintile. And again, it's quite hard to add value here, because what should these percentages look like? There's a mathematical guarantee that will happen if you organise everybody by income. You know, it costs the same to live in a house ultimately. If you've got more money, you may choose to live in a better house, better area, bigger house, more council tax, of course, all of that stuff. But it's marginal, isn't it? The big cost is living in a house in the first place of any kind. So, of course, it speaks to inequality. And the problem is, if you follow these sort of arguments through and what they imply, you can go full John McDonnell and prefer less inequality, but less for everybody. And then consider that as a win when you perform analysis from that angle. And that just doesn't strike me as wise. It isn't an angle that I think is reasonable. It just sounds like a recipe for disaster to me, to be honest. High housing costs have significant implications for the financial resilience of young families. While 25 to 34-year-olds have £3,000 in savings on average, this drops to only £700 for those with cost burdens on housing of over 30% of their income. There's obviously no deposits hopes there, 700 quid saved up, and you're looking at only Bank of Mum and Dad, or a big gambling win, or another stroke of luck, depending on your participation in such things, an inheritance or something like that. Higher housing costs are also associated with worse mental health among young people, with 13% of 25 to 34-year-olds who have housing costs greater than 30% of their income reporting feeling anxious, compared to 8% amongst the total age group and only 1% for those with no housing costs. Now, I must say, I grow increasingly more concerned about mental health as a catch-all term as time goes on these days, because I'm just sick of hearing how many work days are lost to it in this day and age. One thing I feel that we know is that they're not all genuine. What percentage really are bad enough for a day off work? I don't know, and I don't know how we would even try and measure it. But whilst it's an unanswered question, I'm sure there's plenty that feel more harshly than I do about it. The new government needs to address barriers to home ownership and affordability by hitting its target of delivering 1.5 million new homes by the end of this parliament, and permanently relink local housing allowance to cover the 30th percentile of current market rents. Well, okay, but they won't. So why are we pretending that 1.5 million is achievable? It's so silly to even gun for the 1.5 million, because at least 1 million of those the government really isn't in control of. They're going to be delivered by the private sector. Much better to target the number of social homes delivered. And an even smarter bunch would have said how many would be in the pipeline by the end of this Parliament, not how many would have been built. Because a smarter team would know there's a minimum of 18 months prep time to even get the wheels moving at all, really. 6 months in and we've got a guarantee for social rents to increase at CPI +1, which was smart by Rachel Reeves, much smarter than George Osborne. But we've also got a big funding hole that no one, at government level anyway, there's plenty of industry insiders talking about it, is talking about. So, yet. You know the one about Bob Hope and no hope, and Bob Hope has left town? It really concerns me that this target is even being spoken of with any hope of delivery. So that's the headlines. I'm going to do a very selective dive further into the appropriate detail where I think a little more value can be added to the critique. One piece of the longer form summary in the report itself that jumped out is, and to better support low-income families struggling with high housing costs, the government should relink local housing allowance to actual local rents by resetting rates to cover the 30th percentile of market rents in April 2024. But current plans are for these rates to be permanently frozen in nominal terms. Additionally, scrapping the rule that gives a lower LHA to single individuals under 35 would provide essential relief to younger renters in the private sector, whereas housing costs often far outstrip stagnant benefit levels. These measures would help bridge the housing gap between housing affordability and financial support for those most in need. You can see from my emphasis there the bit that jumped out to me. Permanently frozen LHA rates. What on earth do they think this is going to achieve other than rocketing temporary accommodation bills? Again, I can only imagine this is ideologically driven because LHA goes to landlords. But if anyone can set me straight, I'll be pleased to hear from you. Another sentence in the body of the main report couldn't go without comment either. The gap between owners and renters widened further after the 2008 financial crisis. Interest rate cuts sharply reduced mortgage costs, while renters saw no similar relief. Now, this really isn't very accurate. Rents in real terms, and when adjusted for income, fell fairly dramatically between 2005 and 2021. I've analysed this in some detail before. The July the 9th 2023 supplement goes into a lot of detail on this. It's entitled Cheapest for 20 Years, if you want to go and check it out. The rent increases since then have largely been driven by interest rates normalising or rocketing upwards, if you prefer that spin on it. The trend was very much below inflation before necessity drove it up to inflation, and has in recent months driven it beyond inflation when you look at pandemic-inspired inflation in the round. Renters did not directly enjoy lower interest rates, but they did enjoy landlords who, largely speaking, never raised rents intra-tenancy and were spending a lower and lower percentage of their household incomes on rent as that time went on. That trend has now reversed, dramatically as it goes, but the report here is using data that's so far behind, they're not even aware of that situation particularly, and they don't talk about it at any length. But this was the first I'd learned of these LHA perma-freeze plans, and it offers little extra faith in the current administration even beginning to understand the problems they're tackling. One other major factor that's missing here is the potential bias that net migration puts in these figures. Depending on what percentage of net migrants are in the 25 to 34 age bracket, especially if we exclude students from net migration figures, then simply because migrants are much more likely to be renters from the get-go and not have options such as living with parents, if more 25 to 34s are migrants, then that in itself would also skew our figures alongside the above. Now, trying to control for that sort of factor is very, very hard indeed. I'm not even suggesting it can be done. But what I'm suggesting is if you're going to take a piece of research really seriously, that piece of research does need to recognise its own limitations. It needs to show willingness to discuss them, and it needs to make some kind of attempt to adjust for them. That is how proper academia would do it. Anyway, there's an excellent report on migration and housing in the UK that I will save for another day, because I've gone on for long enough this week now, probably to the limits of your patience if you're still listening. However, I did want to share that in spite of the overall goal of the Resolution Foundation, they had produced a headline that supports something I've been saying for years. Those saying how tough it is for the millennials really don't have that much factual evidence, only against the older baby boomers really, when you look at the percentage of income spent on housing. You'd then, if you were keen, need to look at the makeup of the rest of the spending to really get some insight. So, as I draw us to a close this week, last call for the Property Business Workshop. Tickets still on sale for Thursday the 16th of Jan. Great subject matter, planning for the year, efficiencies, financial accounting and bookkeeping, not how to use Xero, but how to ensure reporting is set up correctly and how to monitor it on an effective ongoing monthly basis. Come along and get your strategic planning sorted out, and your January kick up the backside comes as part of the package as well. Early bird tickets, we only have 2 left as I'm recording this. Prices go up on Tuesday at midnight. Snag that 10% face value discount. Once those tickets are gone, they're gone, because these events do sell out, folks. So Rod and I hope to see you there, and you can buy a ticket at bit.ly/PBWFIVE, and there's also a link in the show notes, folks. So there's only one way to deal with all of this ongoing noise and excitement. You know what I'm going to say next. Keep calm, always listen to the supplement, and carry on. Thank you.